We're in Denver, Colorado at EnerCom's 19th Annual Oil and Gas Conference. Joining us now is Steve Lucado, the chairman of TransEnergy. Hey, Steve.
Hey, Quinn. How are you?
I'm great, thank you. TransEnergy is a pure play in the Marcellus. What are some of the major challenges in the region, and how are you folks dealing with them?
Well, it is a very unique region, particularly our area of the Marcellus in West Virginia. One of the things that's unique about West Virginia is that there is no forced pooling, which means that you have to have 100% of the area leased. You can't just get 90 or 95 and then force everybody else. That's compounded by the fact that a lot of these minerals were severed over 100 years ago due to previous oil and gas drilling, or coal mining often was the reason why some of these were severed. So you might have to go find 100 different heirs to those mineral rights and get them all leased up before you can drill on that piece of land. That's one of the major challenges, and we're uniquely situated to deal with that, given the fact that we've got local boots on the ground and as well as the patience to do that. One of the other things that's really come into play recently in this area, though, is the fact that the differentials between what we get on a natural gas price and what is listed there on the NYMEX for the Henry Hub price. You'll probably hear a lot of people talking about this, particularly at this conference. It's really widened out recently, whereas before we would have actually gotten a premium because we were so close to the East Coast market. So that's a challenge. The passage of time will help alleviate some of that, but in the meantime, we're trying to secure up some firm transportation, which will at least help us lock in what that differential price is going to be.
Do you have plans for future joint ventures?
At this point, we're funded with a 2-rig drilling program by Morgan Stanley. It's a recent financing for us that we closed in May. We do have the flexibility under that, with Morgan Stanley's permission, of course, being the lender, to engage in a joint venture and essentially farm out some of our drilling program. We've talked to some various parties about that. Some of the terms are actually quite attractive. Right now we're holding off on pulling the trigger on any of those deals. There are a lot of people that are not even in the basin yet that still want to get in, and that's one way that they might try and get in. So we're seeing interest, but still playing the field.
Steve, do you plan on increasing your drilling operations again in 2015, similar to what you've done in 2014?
Well, at this point, I don't know that we're going to ramp it up again. We went to a 2-rig drilling program recently here in connection with closing the Morgan Stanley financing. I don't know that you would expect to see us go to a 4-rig drilling program and continue to ramp it up. And in fact, if prices don't cooperate, like many, we may scale back the drilling a little bit at some point here. But right now, I think you would expect to see us on that continued trajectory with the 2 rigs, which is quite an expansion for us. We went from having 24 wells online, and then that was drilled over several years, to drilling 19 wells this year alone under our current plan. So you referenced the ramp up. It has been quite big for us.
Are your wet gas wells in West Virginia still performing among the best of your peers?
They are. We found that particularly on the eastern part of our acreage, we really like that as far as the flow rates that we get. As you go further west, we actually get a little more liquids, which of course helps, especially when NGL prices are high. We're also excited, though, about our Marion County acreage, which is dry gas, and we've seen very nice flow rates there. And we think that as long as the differentials come back, we expect those to be about as economic as our wet gas wells.
Steve, the shale boom is just getting up to speed. What do you think is going to drive its continued growth?
Well, the shale boom overall, obviously there's both the oil portion of that and the gas portion. We're just focused on the gas area. I think what will drive it is just there are still really high rates of return to be earned, particularly in basins like ours, in the Marcellus and the Utica, where you can get north of 50% rates of return on a drilling program. Well, that's pretty compelling. That'll keep driving growth.
What do you think can bring it to a halt?
Well, lower prices would certainly, over an extended period of time, cause people to reevaluate that, and possibly shift to, maybe they'd shift more to the oil shales if prices there were remained robust. But that I think is the biggest thing. And of course, as I mentioned before, the capacity to get the gas out of where it's being produced and into the places where it needs to be. If they can't keep up with the drilling, then there may be some disruptions along the way. So we're excited about the future, though, because we think that all that capacity is going to come online and differentials will over time come back to a more normal level.
What else would you like to share with our viewers about TransEnergy?
Well, I think we probably mentioned this the last time we were here. I think our number might have increased, but we are focused on proving out our acreage, checkerboarding the acreage, and increasing the number of well bores that we can drill today. It's a really a bit of a unique twist on a public company strategy. It's a little bit more of a private equity type of a strategy. Instead of trying to drill up a whole pad, for instance, and get the best economics, we're going out and we're drilling wells that are far away from an existing pad and basically saving those good economics for later. So it's one thing to keep in mind that the best is yet to come for us and our assets, and we're trying to de-risk it at this point.
Well, we wish you all the best.
Thank you.
Thanks, Steve. I'm Quinn Nguyen for oilandgas360.com.